Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, February 22nd, 2019. Starting this update, it's almost 2:30 Eastern Time, so we have another hour and a half left to go in the trading session. Not a whole lot new to report, but I do think it's worth an update. And I wanted to get this one out before the close because the last hour and a half in trading today might give us some clues to what to expect next week. Maybe not. As I said yesterday, maybe they'll just park it right around these trend lines. But here's what's happened. I'm going to start out here with the index ETFs, then I'll get to the futures. That's really where I'm more hyper focused, if you will. And then we'll keep this one relatively short. This is the 60-minute chart of QQQ. So again, this is my preferred trend line off the lows. The reaction low on the 27th. We have quite a few clean reactions on QQQ there. And then you have the one that I would imagine as many, if not more, traders are watching that comes off the lows on the 24th. Either way, they come in very close together. And if you give the benefit of the doubt on the back test would be this one, the white trend line. You can see if I pull that a little closer. So right now we've been back testing. So we broke down. And again, these lines I have them pulled in pretty tight, catching all those reactions, that yellow trend line. So we're back testing that. So we're still below trend, still below the wedge that we broke down on QQQ. But as I mentioned yesterday, and especially with the kickback rally we had in the last half of the session, the breakdown looked like it was the real deal early on, and it still may be. Remember, when wedges break down or other chart patterns, sometimes head and shoulders, you name your chart pattern, a lot of times they'll come back to back test the breakdown level or the trend line or whatever it is. And so that's what we have right here. So let's just say status quo right now on QQQ. And as I mentioned yesterday and again this morning, I did a front page post on rightsideofthechart.com with various charts and stated same thing. We have to see yesterday's lows on both QQQ and SPY get taken out. And if that happens, that would trigger the next objective sell signal and most likely start impulsive selling. I believe if we take that out, it's not going to be a limp down, come back up again kind of thing. That's my take. We'll see if it happens that way. And of course, I like that. I like to see the 9 EMA, the signal line on the PPO. I want to see that solidly cross down below the zero, not these little whipsaws that we've had here lately. Let's get a nice cross down there. So that's what I'm looking for. And until then, we're sort of in this holding pattern. You can see we zoom in and we've gone virtually nowhere now for the last week or so. It's mostly sideways trading. Quick glance at QQQ on the daily time frame. It's that same trend line. Again, you just take the meltdown into the Christmas Eve lows, cut that off as a little overshoot, and then this trend line captures it a little cleaner if you chop that off on the bottom. Again, on the 60-minute chart, it comes in right at the reaction low on the 27th. And that's where we're at. So you can see we're below there. So we had a breakdown, but no follow through yet. And again, the trigger, I believe, will be that right there. So until then, it's just more of the same. And you can see, of course, we have some decent resistance overhead, and we get to SPY. I noticed yesterday there was that part in the video where I paused for a minute. What happened is sometimes I'll go to click the pause button and get to the next chart, and I realize I skipped over about 30 seconds or a minute or so of recording there. And I just wanted to point out that although I had we'll look at it here, this was from back on that December 31st year-end market wrap. My max bounce target, and that was the line I was focusing on right around 281. I also had a line here that I wanted to cover, or I did cover yesterday, but it didn't get recorded. So if you take those reaction lows here, let's tighten that line up a little bit. I'm sorry, reaction highs. Remember those 3 key reaction highs. Let's do it like this and try to make it as clean as we can. You can see it's a roughly or a slightly downward sloping trend line, and that's where we're at as well. But as I said, the other line I had was a little higher, 281, give or take. Like I said, you're going to, it's a range. And no matter what happens from here, I do not care if this market goes up 20% without a 3, 4, 5% pullback. I maintain the same thing I've been saying for a while. The risk reward is just not attractive. And then let's just jump over to the 60-minute chart on SPY. We'll look at that. On SPY, I have a trio of trend lines here. This blue one, I'll move it away, but basically this is our divergence line. And I was clarifying for somebody in the trading room today, divergence lines aren't the same as trend lines. Trend lines, I'll revise any trend line, anything on the chart, as need be. But trend lines are a lot less subject to revision. They're your levels you want to buy on pullbacks as long as the trend's going on, or look to position short on a breakdown. But the divergence lines are more dynamic. They're just showing you. They're just the lines that I have parallel to the divergence down on the indicators below. And when you're in an uptrend, the way I responded to that question today in the trading room, you can continue to work your way up, make some higher highs, and you can extend those divergences until the point they're taken out and negated. Basically, if you move over the previous reaction highs, then you no longer have that divergence. So I just wanted to point that out. Now, that divergence line has quite a few reactions, and you can also use an upper trend line as to define a price channel, and that's what I've done here with this blue line. So you take this blue line, it runs parallel to that upper line, and you can see this is a price channel. I'm not putting a heavy weighting on it, I just wanted to mention it, and I did bring it up in recent videos. So the two I'm watching again are the lows off the 27th. That's my primary or most significant trend line, and then the one off the 24th. And you can see on SPY right now, it's back testing that the trend line off the lows on the 24th after breaking down, but it caught support or really had a brief intraday break yesterday, and as I mentioned in yesterday's video, it parked right back up on there. So the same thing holds true with QQQ, and same thing I said yesterday. I'd like to see a break on not just one, but both of those break and take out yesterday's lows. That will have put them comfortably below these trend lines and triggered sell signals on both or confirm the recent breakdowns. Hasn't happened yet, but that's what I'm on watch for. And this is the NASDAQ 100 futures 60-minute chart. Here's that, the trend line, my preferred trend line, 1, 2, 3, 4, a lot of clean reactions, wedge type wedging price action, I should say. Breakdown and NQ is still clearly below there, and there's of course your divergences, everything else. And ES, or the S&P 500 E-mini futures, they're telling a little bit different story. Again, clean trend line off the lows on the 27th back here. A lot of, enough reactions to certainly validate that trend line, but more of a whipsaw signal scenario. Now, what's interesting, and I did this yesterday too. So basically, if you look at it this way, you pop down below and you're slightly above it now. But when I flip this over to a daily time frame, same trend line, you can see really clearly when we zoom in here. That's the same trend line with that candlestick right pretty much on it now. Right before I started the video, the body was a little thinner, but we're on there. So this is, again, I won't mix words here. I think the breakdowns yesterday will stick. I think these are back tests, and that's what this is now. And I think we'll probably, most likely dump into the close today and or Monday and follow through to the downside. That's my take. Oh, let me show you the NASDAQ 100. There it is. Same trend line again. And you can see, like I showed you on the 60, that candle's clearly below there as well. And, of the two, this is really more of the leading index because tech has led this market for a long time. But you got to wait, like I said, wait for them both to break, give the benefit of the doubt to this trend, and then we should get a nice pullback next week. Yeah, I'm going to end with this. Now, I can tell you, unless I am mistaken, and that's possible, I've been doing this for a long time, many years, I don't think I've ever made reference to, or at least not in the sense of the Black Monday 1987, that we'd ever see anything like that again. First of all, in fact, on the contrary, when I've seen it brought up on the site or by other traders, I mentioned it can't happen again. It physically cannot happen due to circuit breakers that have been implemented in the wake of Black Monday back in 1987. But for those of you either old enough to remember or, of course, heard about it later on, I think it was like a 21% drop in one single day. Was the worst drop in percentage terms and point terms in history, or at least in percentage terms, of course. And all I wanted to point out here is, again, that can't happen. But what I'm seeing right now, the disconnect between a lot of things in this rally. If you read up on it back then, we had a similar roaring market, so a shot across the bow. This was Black Monday right here. This was the drop right here. But you had a roaring bull market up to that point, and then a pretty healthy correction You can do the math in percentage terms. This is the Dow 2,700 down to 2,500. But what I wanted to point out too is because I put up that 20 plus year chart of all the previous, at least for the past 2 decades, the previous initial kickback rallies for each bear market. In other words, we're talking the dot-com bubble back in 2000 and the housing slash credit slash Fed bubble and that popped in 2007, led to the '08, '07 to '09 bear market. And the point was that the Wall Street Journal came out on Friday and announced that the NASDAQ bear market is over. We're in a new bull market. Um, and what they neglected to mention is it went back, which I did in time, and all those other previous initial kickback rallies, they averaged over 20%, right around the 20%, a little over 20, right about where we've come to now. And again, this was a bigger move up. So you put things proportionally. This rally could certainly go more. And that also dovetails with another post or something I covered in a video a couple weeks back too about Fibonacci retracements. See, that's where you need to put those moves in percentages, percentage retracements, in other words. And you can see right here, for example, the Dow dropping from 27. Here's the hash marks. This is not log scale, so they're even numbers, 2,500, 2,600. So we're just above 2,700. We dropped to just about 2,500. And you can see we retraced. That's probably about a darn close to 61.8, which is a key Fibonacci level. In the video that I did a few weeks ago, I went through all the at least again, going back 20 years in the bear markets and showed you that typical bear market rally for not just the indexes, but most of the market leading stocks ended right around, give or take, that 61, that magic, not magic, but key 61.8 Fibonacci retracement level. So just food for thought for those that think, that are saying, well, the market can't rally this strong, breadth can't be this strong. Look, I am open to anything, and I'm not saying this has to be a bear market. I'm just saying there's sufficient evidence that it could be a bear market rally. We'll only know for certain in hindsight. But if it is, we're really getting up to that point where it's getting stretched. And like then, there's a lot of, I think, a lot of over exuberance. I think it's those that were late getting into this thing. I was early getting in, went through the bulk of it long trade ideas on the site. I had to clarify that for somebody today, going over the stats on the NASDAQ 100. I'm just show you this again. It's very clear. You look at a daily chart of the QQQ. Let's get rid of all the annotations. And this was it. So we had that. This was most of this period. We were all long trade ideas on the site, at least market related and other things, gold and stuff. That was what was it at? A 13 point, there it is, 15.69% rally. Is that right? If I captured it right? Yeah. Yep. So 16% gain came in just the first 25 days, which is 17 trading sessions. So in just over 3 weeks, 16%. From there, the NASDAQ 100 QQQ has only climbed about 4%. So I did the math. It was exactly 79%, almost 80% of this entire rally off the bottom came on this day. And that's where we added our first official short trade. And we closed out a lot of longs that were in on or around the bottom and closed them out here. So again, what I was trying to do for that member is explain in percentage terms, it's not about how long. This has not been a very strong advance since then, relatively speaking. Again, 4% lift from that point. So it just goes back to what I've been saying. It's about risk return. Risk return, when I say risk return is not unfavorable, it doesn't mean that you must short or the market must drop. It just means that the easy money's been made to put your money in long here, or to keep some longs that don't have stops. For one example would be a 401k type money. That's where I've moved almost all, not all, but almost all my equity funds out, scaled out here at this point, and that's fine. Why? Because you saw it here. This is still a market that was recently broken. There's something going on. There's some things in this market. And if you get one of these days, and this can happen again, a 4+% drop in one day, It doesn't matter if you fire off that order at 9:31 in the morning, tell your broker to sell or go on the line. When you trade mutual funds, which are what's inside a 401k, you get the end of day close. So I don't want to be trapped. I'd rather be out. And look, if the charts start to change and convince me, originally my plan right here, and I've stated before, had some what I call tactical short trades, swing trades. Those are tactical trades. Most of those were stopped out, roughly 3% losses. Went back into a couple in here, had a couple more stopped out. Small positions, tactical trades. The strategic trades are the fact, back here after that first thrust last year when I stated taking, moving, scaling out and moving all my 401k long-term funds into cash and then staying out, avoiding that whole give back and then scaling back in down to here, up to there, and then scaling out. And that's it. So I locked in about 8+% gains for the year from from this little rally year to date. That's plenty. I could sit back for the rest of the year and I believe outperform the market with that. Bulls make money, bears make money, pigs get slaughtered. So that was a plan. And again, I'm separating long-term stuff and strategic, asset allocation and positioning versus tactical, which is swing trading, sometimes day trading, quick trades. And that's where we're at. And then on a final note to that too is also, when you're in a fast moving market and, although, I didn't mean to downplay a 4% gain over what was that, 6-7 week period since that initial surge. Because, historically speaking, there's some years that you're lucky to make 4% in the market. But again, it's relatively speaking. So when you have these sharp price moves, strong trends, and they've been going both ways for over a year now, really, this is critical. So I just, as of last night, a week ago, I rolled out this individual position size calculator on the site. And this is right now, you can come in and use this. You don't have to be a member. Come into the site. I have a little calculator icon right here. You can pull it up under resources. And there's 2 position size calculators. I feel it's very important to not overdo the position because anybody that's feeling pain on shorting the markets in the last, like I said, what was it, 6-8 weeks that we've, or no, 6-7 weeks that we only went up about 4%. If you're feeling pain on that, I can assure you one of 2 things. Either you're loading up too much on individual positions, too high a percent of your own portfolio, or you're trading leverage ETFs or futures or other things and you're not accounting for that level of leverage there. So when you come in here, the first calculator, if you know how much you like to trade, you've been doing this for a while, pick a number. Let's say your average position size is, we'll say $10,000. This will give you, enter your beta adjustment. If you're not familiar with what that is, I talk about it here. Every official trade on the site, I list a beta adjusted position size. So for example, if you're trading SPSX, I think it is the 3-time leveraged short S&P 500 ETF. So you enter 0.33. Why? Because it's a 300% leverage ETF on the broad market. The broad market, SPY, has a beta of 1. So you want to adjust that down by 1/3. So it says if you normally would put 10 grand into a position in SPY, you should only put 3,300. And again, this isn't black and white. In a fast moving market where you have, like we had a few months back, like we've had off the lows from December 24th, not so much recently, but when the market's going up and down 3% plus a day, temper it down. You need to additionally make an adjustment to your position. And then, of course, just enter your parameters here, whether the trade's long or short, because there are different calculations. And, whatever, you buy at 100, you're shooting for 120 on your price target. You have a stop of, let's say, 92. It's going to tell you your risk-reward ratio. I didn't do that right. There we go, 92. Risk-reward ratio 2.5 to 1 tells you should buy 33 shares. Your percent gain, your dollar gain, percent if you're loss, if you're stopped out, dollar loss. And again, it works with short trades. In this one, of course, if you don't know how much you should put in each trade, I plan to add a section where I talk about this. This is also very, it depends widely on the individual, on a lot of factors. But for the most part, let's say you have an account value of 100,000 and you want to risk, let's say 2% on a position, enter that. If it's long, same story. So you're going to go long at 100. You're targeting the same 120. Your same stop is at 95. There it is. There's your risk reward ratio. And although I use a different stop than the last one, your risk reward ratio, how many shares you should purchase. Again, if you, the most important thing here is you're willing to risk 2% of your portfolio size, which is on the high end. Some traders will only do one, some might do a little less, a little more. You're willing to risk $2,000. This to me is make it or break it in trading. If you are risking, let's just say 10% of your portfolio, you have $100,000. You take a $10,000 loss. You're down now to $90,000. You have a string of those. You're going to get to a point where it's going to be almost impossible to get back. Why? It's the way math works. You have $100,000 and you lose 50% of your money. You get to 50 grand. You then have to make 100%, not 50% to get back to where you were. You have to double your money, and that gets hard. So you can't dig yourself in a hole. This is important. So take advantage of these calculators, use them as you want, and it'll do the same thing. It'll give you your profit target, your dollar amount, percentage. But this is important here. So again, it comes back to anybody that's taking it on the chin. And look, it works the other way. If you're long and you're leveraged out and you're riding high right now, just be aware if the right headlines hit and you wake up to a big 3+% gap down and you're too heavy in long positions right now, trades can go against you. And that's where traders usually get in trouble. It's a psychological thing. You get trapped in a position. You say, oh, well, I'll just wait till I get back to where it was. And then your 3% loss turns into a 5 and then a 7 and a 10. And I'm sure at some point most of us have been there, and myself included. So anyways, take it for what it's worth. Again, it's on the right side of the chart. There's a little icon up there where you can find that menu under the Resources tab. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.